Have you ever wondered what your business is actually worth? Not just the number in your head, but the number of buyers actually willing to pay for it? Let me show you. Using a real company we worked with, I've changed the name and adjusted some of the details to keep it confidential. We're going to call it Lone Star Plumbing, a $5 million shop here in DFW. Now here's what makes this business worth breaking down. We're going to take a look at it two different ways. The first way was the way that it ran with the business being built around the owner. The second way is the way that it runs being built to sell. Same company, same revenue. One version sells for a premium and lets the owner walk away clean. The other might not sell at all. And I'm going to show you line by line exactly why. Now this is very exciting because this is the first of 3 videos in this series. In this one, we build your baseline valuation, what your business is worth today, and who can actually buy it. For most of this, we'll walk through the first scenario, the owner run version, and then I'll reveal the second scenario of what a version looks like built to sell. Then we'll compare the two. So let's dive in and meet the business. All right, so first we're going to do an overview of the business because valuation starts with context, not just a number. So Lone Star Plumbing has been operating for 15 years. They're doing $5 million a year in revenue. Only 5% of that revenue is under service agreements. 10% of their business is coming from commercial partners. They have 2 licensed plumbers, 14 total employees, 6 trucks on the road, and the current owner is working 55 hours a week in the business. He's in the field, he's in the office, he's quoting, he's running payroll, he's solving every single problem. Now hold on to that piece because it's going to matter more than anything else on this list. Now we're going to get into the fun stuff, the money. Let's walk the P&L top to bottom and I'll define each piece as we go. So again, they're doing $5 million a year in revenue. That's just money that came in from the jobs before any costs. In other words, your top line. Next is cost of goods sold, totaling $3 million. That's all the direct costs of doing the work, the parts, the pipe, the labor, so on and so forth, what it actually costs to deliver. Deducting that leaves us with $2 million in gross profit. Now, gross profit is basically what's left over after those direct job costs that can be used to pay to run the rest of the office. Now, when you take a look at gross profit in terms of revenue, that leaves us with gross margin. Now here we have a 40% gross margin, which is pretty healthy for a shop like this. Now margin just means how much of every revenue dollar survives. So now we can jump into operating expenses. So first is payroll and overhead at $580,000 and another $150,000 in other operating expenses. These are just the costs of running the business behind the scenes. Office staff, dispatch, fuel, marketing, insurance, so on and so forth. When you take all that out, we land at $1,270,000 in EBITDA. EBITDA basically stands for earnings before interest, taxes, depreciation, and amortization. In plain English, it's the operating profit, what the business actually produced. Now let's keep going down the page because the number most owners fixate on is at the very bottom. Under EBITDA, we take out depreciation and amortization of $120,000. This is basically accounting for truck and equipment wearing out over a period of time. Now this is a paper expense. No cash actually leaves the account for this. That leaves an EBIT, or operating income, of $1,150,000. From here, we can deduct $45,000 in interest on any truck or equipment loans. This gives us a pre-tax income of $1,105,000. At a tax rate of 25%, our tax liability is $276,250, leaving us with a bottom line net income of $828,750. Effectively, this is what's left after all of our expenses and taxes are accounted for. Now here's the thing most owners get backwards. A buyer basically ignores that bottom line number because everything below EBITDA, the depreciation, the interest, the taxes, is either an accounting choice or a financial choice. It's not how the business actually performs. 2 identical shops can show completely different net incomes just based on how much debt they carry and how they write off their trucks. So a buyer climbs back up the page, back up to EBITDA, and for a business like this, to a number that's even more useful. Let me show you. And that number is SDE, Seller's Discretionary Earnings. Because the owner is so central to everything here, this is the number that actually fits a business like this. It's how a buyer figures out the real financial benefit of owning it. We start with EBITDA, $1,270,000, then we add back what the business pays the owner, his salary of $150,000, and any benefits or perks he runs through the business, another $40,000. We add those back because a new owner-operator would pay themselves instead. It's a perk of ownership, not necessarily a true cost of running the business. We also add back one-time unusual costs. Last year, they maybe had a small legal settlement or rebuilt a truck engine, totaling $15,000 together, which they won't expect to happen again. We add it back so we normalize SDE, looking at a normal year, not a fluke. A buyer does the same thing.
Add it all up, and the owner's total take, his SDE, is $1,475,000.
So in plain terms, SDE is the total financial benefit to one hands-on owner. The profit plus what you pay yourself plus any perks. Now here's the seed that I want to plant because it's the entire game. Small owner-run shops get valued on SDE. Once a business can run without the owner, buyers shift the valuation methodology over to an EBITDA valuation. Which one applies to you isn't necessarily a choice. It's decided by how involved the owner is. Remember that because we're going to circle back to that later in the video.
Now let's value scenario A the way the market would actually do it today. It's an owner-run shop, so it's an SDE business. We take that SDE and multiply it by a market multiple. And real quick, what's a multiple? It's basically just what a buyer pays per dollar of earnings. Think of it as a payback gauge. A 3x multiple means the buyer expects to earn their money back in about 3 years. For an owner-operated plumbing shop in North Texas of this size, that multiple typically lands between 2 and 3x of SDE. Here, we'll use 2.4x. We take SDE of $1,475,000 times our multiple of 2.4, and Lone Star Plumbing comes out at $3.54 million of enterprise value. Now, enterprise value is basically just the value of the business itself. Think of it as the sticker price. This is your baseline. This is the number if you sold as is, with you still in the center of everything. But here's what trips up almost every first-time seller. That $3.54 million is enterprise value, not what hits your bank account when you sell it. You have to bridge from the sticker price to what you actually walk away with. Now, two big things move that number. First is debt. The owner still owes $600,000 on trucks and equipment. In a normal deal, that debt gets paid off at closing right out of the price. So that $3.54 million turns into $2.94 to the seller. Second is working capital. This one gets skipped in almost every conversation until it costs somebody money, so stay with me here. Working capital is the everyday money tied up in running the business. Your receivables, your inventory, minus what you owe to vendors and any deposits customers have already paid you. Think of it as the fuel in the tank. It's what covers payroll and materials on Monday for jobs you won't collect until next month. Every deal sets a target for it, called a peg. The normal level this business needs to operate, usually the average of the last 12 months. And here's the part most people miss. The price already assumes you're handing the business over with the full tank, so it settles both ways at closing. Come in under the peg, and the buyer has to write a check on day one just to fund normal operations. They already paid you for that fuel, so the price comes down dollar for dollar. Come in over that peg, and you left more in the tank than the business needs. That's yours, so you get paid for it dollar for dollar. In our example, Lone Star hands over $150,000 less than that peg. This owner had been running on the float, stretching vendors, taking customer deposits up front, collecting slow. That works when it's your business and you know the rhythm. It doesn't survive a closing statement. So that $150,000 short of the peg is $150,000 off the check. That's not a penalty, it's basically a settlement. So watch what happens. A $3.54 million business minus $600,000 of truck and equipment debt minus another $150,000 in working capital gap nets the owner $2.79 million. In other words, $750,000 never makes it to his pocket.
So in other words, same sticker price, very different money in hand, depending on your debt and your working capital. We'll go deep into cleaning that up later in the video. For now, just remember the sticker price and your net proceeds are two completely different numbers.
So now let's look at the exact same company run a completely different way. Same $5 million in revenue, but let's see what's different. The owner now works 5 hours a week. There's a general manager running the day-to-day. They've added a service manager, and they've got strong lead techs taking point in the field. They've grown to 6 licensed plumbers, 21 employees, and 12 trucks. 30% of the revenue is now under service agreements. Commercial work is up to 35% on top of the residential, and they're running dispatch and field management software to schedule, route, and track every job. All of that costs money, so the profit is actually lower. EBITDA is now $875,000, an 18% margin, and when we build SDE, the add backs are smaller as well because the owner barely works in it. So SDE is now $985,000.
So on the surface and even on paper, this business doesn't look as great. Less profit, more overhead, lower margins. So why is it about to be worth more?
So here's the twist. If you valued scenario B on SDE the way we did in scenario A, it'll come out lower. $985,000 at a 3.1x multiple is $3,053,500. Now we use 3.1 because it's a little more transferable. The owner isn't as involved, so it commands a premium. This is the trap that fools most owners. They build a team, they step back, their personal income drops, and they think they made the business worth less. Well, they didn't. They changed what the business is. Scenario A can only be sold on SDE to a buyer who's willing to step into that 55-hour-a-week job. They're buying themselves a job. Scenario B, on the other hand, can be valued on EBITDA at 5.5x because it runs without its owner. It's an investor-grade business now, not just an owner-operated job. Now we'll run Scenario B through the same bridge, and we'll see what happens with the working capital. So an enterprise value of $4,812,000, less net debt of $900,000. That's higher than Scenario A because this version borrowed to buy trucks and put systems in. And then working capital plus $75,000, it's positive this time. Why is that? Well, this version of the business isn't living on float. 30% of the revenue is under service agreements and more of the work is commercial. So there are real receivables on the books instead of cash collected up front. They stock their trucks instead of running to the supply house mid-job, and they pay vendors on terms instead of stretching them to fund payroll. So they hand the buyer a tank that's fuller than the peg, and they get paid for the difference. So here we have an estimated equity value to seller of almost $4 million.
Same line item, two different directions. Scenario A hands over a tank that's short and pays $150,000 for it. Scenario B hands over more than it needs to and collects $75,000. That's a $225,000 swing on one line most owners have never even heard of. And working capital doesn't get fixed the month before you sell it. It's built by how you've run the business for years before that. And this is the most important thing I'll say today. The way your business is valued follows the buyer, and the buyer follows how transferable your business is. Scenario A sells to a private buyer, an individual, maybe a tech or a supervisor who wants to own their own shop. They know they're going to be in the field, on scheduling, answering the phone at night, because the business was never built to run without an owner. Smaller pool of buyers, lower multiples, SDE valuations, and the seller usually has to stick around 1 to 2 years to hand it off. Scenario B, on the other hand, can sell to an institutional buyer, a private equity group building a platform, a regional plumbing company looking for a bolt-on, a strategic buyer expanding into DFW. They don't want a job. They want cash flow that runs whether you're there or not, and a team that stays. Because it transfers cleanly, they value it on EBITDA at higher multiples, and they're more open to letting you actually walk away. Again, same company, same revenue, completely different buyer because one version is transferable and the other isn't. And I want to be crystal clear here. This isn't some spreadsheet trick or creative accounting. Scenario B isn't worth more because we changed some of the formulas. It's worth more because of everything you can't see in the P&L. It has the right team so the business doesn't live or die with one person. It has systems and documented processes so jobs get booked, dispatched, and closed the same way every single time whether the owner is there or not. And it has a culture that keeps the key techs and managers through a transition, which is exactly what a buyer is terrified of losing. Those are the things that make a business transferable. The higher valuation is just the financial shadow of good operations. Build the operation and the value follows. That's the through line of this whole series. All right, quick detour because this ties right into what we're talking about. If you're buying or selling a business anywhere in North Texas, there's a resource I always point people to all the time. It's called the North Texas Business Exchange. I'll link it up here on the top. It's an independent site built for local buyers and sellers. You can pull a quick, no email preliminary valuation in under 2 minutes. You can see how businesses like yours are actually being valued in this market right now. And there's real education on there about how the whole buying and selling process actually works, which is what most owners have never walked through. So there it is. Again, there's a link in the description below. Go run your own numbers. That's the starting point of this entire process. So what we just did here, the SDE buildup, the buyer analysis, the bridge to real proceeds, that's the deeper, defensible version. And that's the work that actually moves your number. So here's your baseline lesson. What your business is worth isn't just about how much profit you make this year. It's about whether it can run without you. Because that's what decides who can buy it. And who can buy it decides whether you're valued on SDE or EBITDA and what the multiple is that they'll pay. In the next video, we'll go lever by lever on the exact things a buyer penalizes you for and what each one costs. And in the third video, I'll show you the operational playbook to close those gaps and graduate your business into a higher value, easier to sell company. Again, same numbers, same business, two completely different outcomes. If this was helpful, follow along and send me a message. I'd love to hear where your business lands.